right. Hey there. Welcome to this fresh episode of Chasing the Vision. This is episode 4 in our 2025 season, which is really exciting. In the last episode, we discussed the importance of financial management and cash flow in a business. These areas are obviously critical for growth and value in any organization, especially when it comes to funding that growth. Most business owners do not have an unlimited supply of capital resources to reinvest in their companies. So, how do you grow when you don't have those resources? And that is why we are bringing in a very special guest today. I'm very excited. I think that this is going to have a lot of insight, a lot of wisdom in this episode. So, Seth Vander Woude, he is the VP of Small Business Lending at Live Oak Bank. He is joining JT Cry from Exit Strategies and Tim Hull from VMA and I in this discussion to talk about finances and how to help your business grow when your cash flow you're at the end of yourself. Where can you go from there? So, Seth, I'm going to toss it over to you first to kind of introduce yourself and share a little bit about your background.
Sure. Thanks for having me, and excellent pronunciation. That my name gets brutalized quite often, so appreciate that. Yeah, my name is Seth Vander Woude with Live Oak Bank. I have been in the banking industry since 2001. Moved into the SBA side of the bank in 2008, and I've been focused exclusively on lending to restoration and cleaning companies since 2019. So I've had the pleasure of working with JT and folks like JT and Tim in the past, and so I appreciate the opportunity to join you guys today.
Awesome. Okay, so Tim and JT, at the end of our last episode, once we stopped recording, we talked about should we bring in a special guest, and both of you were like, Seth is who we should bring in. So Tim, I'll toss it to you first. Share a little bit about why you knew that this was an important conversation to have, and why Seth was the right person to bring into this point of the conversation.
Yeah, absolutely, Michelle. And now that you say that, I'm thinking like we should have an outtakes or a reels of the post recording sessions just to see how comical the discussions are. But you're right. I think in the last episode, we were talking about financial cleanliness of an organization, how important the bookkeeping and the financials really are. And in a second, kind of chair to that is always financing growth. And we run into this with our clients a lot. And JT, I'm sure you see it with the clients that you've got. If you just gave them 50, 100, 150, $200,000 more, how much more could they grow their business? I've always loved the name of the bank, Live Oak, right? Because everybody says, well, I don't have a money tree in the backyard. Well, maybe you could have a money tree in the backyard. But you're right in your intro, Michelle. What we see is the struggle that the profits being reinvested into the organization just, they're not enough a lot of times to allow an organization to reach its full potential. So that's kind of where I was coming from my observation point.
Perfect. Okay, JT, what's your take on bringing Seth into the conversation, especially from maybe the exit strategy standpoint and having someone like a Live Oak Bank that can help bring money into the business to help it grow, increases value, all the things. What's your take?
Well, I appreciate it, Michelle, and appreciate being here today. There's really a couple ways that Seth and I work together and have worked together in the past. One is through a transaction, and that's not what we're talking about here today. What we really are talking about is growth and the need for capital as you grow. And there's a lot of misconceptions around lending, around bankers, about what the SBA can and can't do, when to talk to the SBA, when not to, when it makes sense, et cetera. So I'm excited to have Seth here today to help clear some of that up. Because I know the rules have also changed in the last, 18 months, Seth, 12 months?
Yeah, there've been a lot of changes recently.
Yeah, so I don't know all those. I haven't done an SBA deal for a while. My deal size is a bit larger than that now, but I'm excited to learn more, and I'm sure Seth is up on all those rules. So no pressure, Seth.
No pressure. Okay, I'm going to jump around a little bit. So, Seth, can you set the foundation for us on SBA loans, like the parameters of them, who would qualify, who would not, who's a good fit, who's not, those kind of things?
Sure. So I think probably the most important thing to put out there is just that the reason everyone hears so much about SBA is that, quite frankly, for newer businesses, acquisition, it's certainly in the mainstream world anyways, that really is typically the only option. I mean, certainly you may be able to find some alternative options, particularly if you have a incredibly strong personal balance sheet or something like that, if you're talking conventional. But 99% of the folks we run across on a day-to-day basis are really going to fit into the SBA world. There's just a lot of flexibility around, lower down payments, longer amortizations. It allows for, banks to lend where they wouldn't otherwise be able to. And so, it allows for financing from anything from startup to acquisition, expansion, equipment, purchasing real estate, sort of anything a business might need, SBA can address that.
Perfect.
Seth, I've got a quick question. Can you address really how an SBA-backed loan is really a cash flow loan and not a collateralized loan? I mean, it is to an extent, but I think there's some mystery surrounding that. And owners will often think, oh, I can't go get an SBA loan. I don't have a collateral for that, because we're in the service business, right? I mean, you can generate millions of dollars in revenue and earnings with very few assets. So if you could touch on that, I think that'd be helpful.
Sure. So that's one of the beautiful things about SBA. I mean, there are certainly parameters in certain situations trigger things where it wouldn't otherwise. And so it gets a little complicated. So that's part of what we do, is obviously talk through each situation is a little bit different. But to your point, there really is no just flat across the board collateral requirement. We have to take a UCC filing on the business. Obviously, the business is the applicant. The individual owners of 20% or more have to be guarantors. That's pretty black and white. But in terms of collateral, just from a generic standpoint, there really is no definitive collateral requirement other than the business being the applicant and having to qualify from a cash flow standpoint. Now, if you want to get into the weeds a little bit more, there are, if we're financing a piece of commercial real estate, obviously that is the collateral. Or at least the primary collateral. And then there are situations where if the guarantors, owners of the business have, other collateral with real estate, for example, with lendable equity, there are situations where those have to be taken into consideration, but it's not a requirement just from high level in terms of qualifying.
Perfect. Okay, so go ahead, Tim.
Seth, help me out. Let's kind of set the stage for the audience a little bit. A lot of people are hesitant to borrow money, and especially in the restoration space where, startup costs are relatively small. Growth can be expensive, but startup costs are small. A lot of times they'll try to fund the growth through their own, personal assets. What would you say to somebody that is hesitant to borrow money to help either start up or grow their business? I guess take the fear out of, is debt a bad word these days?
Yeah, no, I would, as you probably know, it can be difficult to convince business owners that debt is not bad, but certainly a healthy level of debt is definitely not bad at all, and quite essential in many cases. And one of the things I really try to encourage people to do is to make sure that they really think through, how much they need, and to not have to be in a position where they have to come back after the fact. I have people come to me all the time and state, I worked with XYZ bank, they didn't give me enough, and now they won't give me more. Unfortunately, in those situations, it becomes a lot more difficult to extend capital at that time than it would have been had we addressed a larger amount up front. So it's always better to get more up front within reason. And, going back to sort of the flexibility of SBA loans, there are no prepayment penalties on a standard 10-year SBA loan. So if it turns out business goes well, maybe you didn't need quite that much, you can very easily pay that back if you get to the point where you have excess cash and there's no penalty for doing that.
So what I took away from that is ask money when you don't need it and ask for more than what you need.
That's exactly right.
Tim and JT, I'm curious from your standpoint, Tim, kind of leading along the question you just asked Seth, what do you guys tell owners that come in and they're like, I really don't like debt. Maybe they're a little risk averse and they fear the rejection. They are like, no, I don't know if this is the right path for me. What do you tell those owners who are looking to grow but are nervous about taking on debt?
Yeah, I mean, at a very base level, Michelle, I mean, we try to show them through numbers. We can run some different ratios and analysis and forecasting based on what the cost to borrow that money is versus the expected rate of return from the business. If the business is profitable and you put more money into that business in terms of capital by borrowing it, the rate of return on the backside, just because you borrow money doesn't mean you're necessarily going to make less at the operating line than what you were making before. Theoretically, you should be able to multiply that, right? So from financial analysis standpoint, we try to show them, hey, this is what's possible, and have a rational discussion with it. Try to take the emotional impact out of it, which we all know can cloud our judgment when it comes to any financing decision.
For sure. JT, anything to add on that one?
Yeah, I'll just add a quick comment. My perspective is a little different because when owners call me, they're typically in the fourth quarter of their career or they're planning. They're on a 3 to 5 year plan. And so they're not looking so much to grow, maybe greenfield a location or something. But so many well-run restoration companies are debt-free or nominal debt. And you start looking at a payment of $5, $10, $15, $20,000 a month. It's intimidating. But the business oftentimes can more than handle that with ease, especially for the ROI that's involved. And so if there is growth plans before a sell, I just have him call Seth. I mean, he's got a wonderful way of putting this into English. And I know, Seth, you're going to use some terminology today that a lot of listeners are probably not familiar with. And that's one of the reasons we love Seth, is he can boil this down into plain English very quickly. So don't be intimidated to call Seth. How's that?
So, Seth, maybe you could help us out. Like, is there a difference between good and bad debt when you look at a business? I mean, you see both sides of the coin there. You're trying to lend them money, but you're also critiquing maybe the debt that they have existing. What's good debt and what's bad debt for a business owner?
Sure. So, I mean, speaking of bad debt, I would say the request that we maybe see more often that I would maybe look at as bad debt is, debt refi, although, debt refinance requests are certainly a viable request, and in many cases they make sense. But unfortunately, what we see oftentimes is folks are in a bind and they make the mistake of obtaining some short-term working capital loans with payments that are just astronomical and just don't work for them. And then they're scrambling after the fact to try to fix that. And so in some cases that may be something we can help with. But those are definitely, challenging situations when they, are scrambling last minute and just kind of take whatever they can get really quick rather than the appropriate debt instrument.
Okay. So Seth, can you talk through, I know you laid the groundwork for what SBA loans are, but are there different types? Why can they be good options for like restoration contractors, maybe specifically? And then what kind of challenges do you see? Maybe I'm getting too many questions ahead, but talk about what they are specifically and why they're good for service businesses.
Sure. So in terms of the types, that's a pretty easy conversation. I mean, really you have 7A, which, without going into a lot of boring details, basically covers everything. So anything you can imagine needing for your business, a 7A loan can help accomplish that. Term loans, lines of credit. So as it relates to the restoration industry, one of the things that really stands out and kind of how we've positioned ourselves in the industry is providing lines of credit. Many banks are really challenged with that and providing any kind of meaningful level of working capital for smaller businesses. And then there's the 504 product, which really is exclusively for real estate. So if you are, doing a rent replacement, you're buying the existing, real estate you're currently operating from, or another one, or expanding and expanding through the acquisition of real estate. 504 is an option for that, but 7A is as well. So oftentimes, even if you are utilizing the 504 program, you may actually package that with a 7A if you need working capital, for example, because the 504 is limited to real estate proceeds only.
Okay. And what are some of the, what does it look like when you apply? How long does it take to get approved? How do you get the funding? Any red tape that people run into?
Sure. So I usually break it down in sort of a couple phases. One is pre-approval. What I do is after the conversation with the customer, what I'll do is I'll send them a needs list of things that are helpful to get a good sense of whether or not I can help with the request and addressing the pre-approval. I usually quote about 2 days for that. Usually it's less than that, but 2 days is sort of on the long end. And then once they get a chance to review that letter, we go through any additional documentation that's needed to go to underwriting. That underwriting process will take about 2 weeks. And then from beginning to end, I mean, there's a lot of variability there, but we generally quote in the neighborhood of 45 to 60 days. And a lot of that'll just depend on the dynamics of the transaction, when our final purchase and sale agreements ready. If there's a franchise, is there a franchise agreement ready? Lease agreements, things like that. The stuff on the back end is really where it can be pretty difficult to predict because People always want to close quickly, which is great, and we're certainly on board with that. But oftentimes the back end documentation is really what slows the process down.
And I'll lob in another thought here too. I think there's a misconception with many people outside of the SBA world, and Seth, you can challenge me on this if you want to, but I think people think this SBA process is really onerous and it's exhaustive, and they're looking for ways not to loan, and that's not true. I've done many SBA deals over the years, and there is a due diligence process that has to happen. These are uncollateralized loans, so yes, there's the Seths of the world have to do their homework. But it is not an onerous process. And typically, the SBA lender is not the bottleneck. It's the owner trying to round up accurate data and supply everything that the bank is asking for. And yes, it's a little bit of a list, but it's not an exhaustive list. It is very doable. And people think that once they get into this SBA world, they're going to drown in paperwork. And that's just absolutely not the case. Seth has a great way of walking people through it, and it's not as painful as you think.
So, Seth,
Yeah.
what are some of the common hiccups that you see with applicants?
Yeah, I think the biggest thing is, most people are great to work with. There are situations where, people are more focused on asking, why this is needed and things like that. And that's where things tend to drag on. Really, it's a function of this is what's required. The sooner we get it, the quicker we can get you an answer. And so, to JT's point, just be prepared to provide what's needed. I know it's not a fun process, but at the end of the day, the sooner we get that stuff, the sooner we can get you an answer, and the sooner we can get the money in your hands.
And Seth, before we move on from 7A or 504, can you talk a little bit about bundled loans? I'm going to shift gears just for a second, but if this were a transaction, a buyer comes along and buys the business and the real estate, there can be bundled loans, correct, with the 7A and the 504 with, not a 25-year real estate, not a 10-year business, but they're bundled together as a hybrid. Can you talk through that just for a minute?
Sure. And so some of those can get pretty complicated, and there's a lot of different ways to do it. But to touch on one example there, let's say you're to your point, you're buying a business and you're buying the real estate is included. So you could do, sort of just to simplify it in two simple ways. You could do a 7A loan to cover everything. If the real estate represents 51% or more of the overall financed amount, you can do a full 25-year amortization. So that's typically a very popular option, just simply because you have one payment. It's all amortized out over 25 years. It's the simpler process and a lower payment overall. Yeah. The other option is you still have to utilize 7A because the business acquisition piece has to be financed through the 7A program. But you can break it out and you can do a 10-year loan for the business assets, and then you can then couple that with the 504 program and finance just the real estate with that piece.
Terrific. Thank you.
Perfect.
And then there are also situations, just to mention, sort of, it's referred to as pari passu, but for larger transactions, people often hear the limitations of 5 million. But there are ways to go above and beyond that with both the 7A program and the 504 program with utilizing additional products.
So a lot of that was talking about kind of the mergers and acquisitions, sale, that kind of side of the coin. But Tim, I'm curious on your side, at what point do you start recommending to your clients, hey, it might be time for you to start looking into some sort of outside backing other than bankrolling this whole thing yourself? Because I could see owners getting to the point where it's almost an emergency and they need it, and it's like then it slows everything down. So to try to be a little bit more strategic and look ahead, when do you start advising your clients of maybe you should start thinking about this now?
Great question, Michelle. And I think once our clients get to the point where we hit what I affectionately call no man's land, or that period of time where you're going to go through a capital reinvestment period, usually they hit it somewhere between $3.5 to $4 million, upwards of 10 million. So in that window is what we see a kind of a diminishing returns at the bottom line, because the company is reinvesting cash faster than they can produce it in some instances, and the bottom line margins get squeezed. Once you get beyond no man's land or that capital reinvestment period, then things start to accelerate. And JT, you probably see this with evaluations that you do, where there's that kind of gap, size in the middle there where margins are kind of thin at the bottom. But really what they're doing, Michelle, is they're reinvesting that cash. But if you can get more operating capital either through, lending source or some other method, you can accelerate that period of time that you spend in that reinvestment period. And then once you get the other side, I tell people all the time, it's kind of like driving across a rocky, bumpy road. The faster you drive across it, the less you feel the potholes. Same thing. You want to step on the accelerator, but you need financing as the accelerator to get you through there.
Yeah, don't drive over the potholes too fast if you're not filling them and it doesn't work out well. Okay, Seth, can you talk a little bit about, you've talked about the paperwork, the timeline, what people need to submit. What are some of the friction points that happen when people are starting to submit the documentation that they need to submit? What things really need to be in order and kind of clean, I suppose, from a financial standpoint when you're starting to get all that paperwork?
Yeah, I mean, in terms of on the financial side, I mean, the primary things we're asking for are tax returns, both from the individuals and the business, and then either year-end statements or interim statements, depending on where we are in the year and when taxes are being filed or if they haven't been filed yet. So I think the biggest thing there is just, are their company prepared, assuming they don't have, compiled financial statements, are their company prepared statements of any level of quality that we can rely on, right? I think for the most part, the answer is yes. Sometimes we'll see some that are clearly, not accurate or not done well, and that can be concerning. But for the most part, we don't have a lot of issue with that. And then the other stuff, in terms of application, personal financial statement, if a business plan is applicable, projections, things like that. Sometimes people have never, worked through the process of doing a business plan or projection. So if that's the case, we can kind of help guide through that as well. But those are some of the things that stand out.
Okay.
Seth, what kind of things would warrant an explanation that wouldn't be readily apparent in the numbers? What should lenders or borrowers be prepared to support?
I think anytime there's, wild fluctuations in revenue or profitability, we're certainly looking at trends. Has there been growth? Is it reasonable to expect that there'll continue to be growth? If there's wild fluctuations in profitability, just understanding why. That can, just at first glance, that can be very concerning, but sometimes there's a very simple explanation for that. And oftentimes we just have to dig deeper and understand, what led to that and why we're comfortable in, how do we mitigate that? Is there a way to get comfortable with, why there was a drop in profitability? And oftentimes there is.
I've got a smile on my face as I'm listening to that answer because I'm just coming off a valuation where this couple worked really, really hard to bury tens of thousands of dollars of personal expenses in their business. And this is one of those instances where you've got to work hard to uncover it. And they were essentially complaining to me about how difficult it is to uncover it. And when you work that hard to bury expenses, you're going to have to work hard to uncover it. And this is part of the story that is needed for any kind of lending event. And sometimes they get buried too deep and you can't back up from that. There just isn't a paper trail. And so I think, Seth, that takes it a little further than what you were talking about, but there has to be a narrative that overlays the numbers as well.
Seth, do you have any kind of success stories specifically from the industry of, obviously in generalities, a company that decided to go the SBA loan route and how it helped them kind of reach the next level in their business?
Yeah, sure. I mean, I think the first one top of mind, I'm working with them right now, so it's easy to kind of think about that one. We started with them back, I think, in 2021, provided startup financing. This one happened to be a franchise business, so we provided a term loan and a line of credit so that they could launch their first territory. About a year or so later, they were knocking it out of the park. They came back. They were expanding to an additional territory. We stepped in and provided another term loan and another line of credit for that expansion territory. And now they're back to purchase a larger facility to facilitate the continued growth. And so now we're looking at financing a piece of real estate for them. So that's one of the things we want to do. We want to lend to good operators, but we also want to be their long-term lending partner. So that's a classic example of how we want to be involved is helping them from inception, and all the way through their growth. So, we do offer, although my focus is exclusively, or at least primarily SBA, we do conventional as well. But we do have middle markets team as well. So to the extent that someone, grows so large that they're sort of outside of the SBA world, we still have solutions for that as well.
So what are some of the benefits? Dig a little bit deeper into that. You've had an ongoing relationship with this company, and that has been, I'm sure, a significant differentiator for them when they're seeking lending, seeking help with growth. So how does it work once you have that relationship established? Does it make kind of getting the loans moving forward a little bit easier? I'm sure that ongoing relationship lends a lot of opportunity for companies.
Yeah, for sure. I mean, assuming their numbers are good, we have the familiarity of having write up. The underwriters put together a pretty extensive write up and narrative on the business, and so that we already obviously have that in our system. It's ready to go. So really, what we're doing is just looking at the updated numbers. How do those compare to what maybe their original projections were, and then what changes, if any, have happened to the business. Has there been any change to ownership? Any additional territories, like we mentioned, things to sort of update that narrative from an underwriting perspective. But yeah, it definitely makes it easier to continue to lend to that individual, given the knowledge we have of them and the history of them making payments.
Seth,
Seth, when you're
no, go ahead,
Tim.
JT. Go ahead.
Okay. Quick question. When you're partnering with an owner like that, do you ever get involved in advising an owner on when to capitalize certain expenses, when just to expense them on a P&L versus capitalize them on a balance sheet? Do you ever assist with those decisions, or will you just follow the lead of a CPA?
Yeah, so we have to be a little bit careful about having any conversations around accounting entries. So yeah, I'm
Okay.
typically going to advise, depending on who they're currently working with. If they're working with someone like yourself or Tim, their CPA, for the most part, we're gonna refer them back to the
Okay.
specific expertise of the industry.
Okay. Thanks.
Seth, one of the more common questions that we get a lot, especially from our clients, is how much should I have ability to borrow on a line of credit, operating line?
Mm-hmm.
Yeah, so the way I typically look at that is it depends a little bit on the mix of their revenue, right? How much mitigation are they doing versus reconstruction? Are they doing, cat work, that sort of thing? So depending on the answer to that, maybe the calculation will be a little bit different. But generally speaking, we target somewhere in the neighborhood of 10 to 12% of revenue in terms of available working capital. So in the case of like an acquisition, for example, we're kind of looking at that revenue mix, what the business is doing revenue, what the buyer can realistically expect from a projection standpoint. Do they have a reasonable case for how they can immediately grow the business, or is it, kind of continuing as is? And then through either permanent working capital, just meaning the portion allocated to the term loan versus line of credit, we want to make sure that number is, typically at least in that range.
Nice. Okay, so Seth, you also talked about there are alternatives to SBA lending. So if somebody is seeking another option, what are some of the other common alternatives out there to an SBA loan?
Sure. So as it relates to equipment, we typically are going to provide, I guess, if you want to call it equipment package. So the ancillary equipment, I mean, commonly we are financing that. When it comes to actual vehicles, we're typically going to recommend, although we can do that, we typically recommend that they go to, directly to manufacturer or fleet financing, something like that. The terms just that product typically makes more sense for vehicle specific. That said, we can do it if needed. And then I'm sorry, can you repeat that question?
That's okay. We're talking about alternatives to SBA
Oh,
lending.
right.
What
Sorry.
options are there? That's okay.
I got off on a tangent there. So yeah, I mean, the obvious alternative would be conventional lending. I think where customers sometimes get a little confused is sometimes I think they think it's one or the other. The overwhelming majority of people we speak with are not going to fit in the conventional bucket. When you think conventional, you really need to think, long-standing business, super strong cash flow, super strong liquidity on both business and personal side. And then also understanding that there are a lot of disadvantages with conventional as well. It's shorter amortizations. Instead of doing, a 10-year amortization, you're looking at 5 to 7. You've got covenants in place, which don't exist in SBA. So it's important to understand that not only is there a different level in terms of being able to get approved for that, but also there are disadvantages that come with it as well.
Okay. That makes sense. That makes sense. So, all right, so let's go into strategy a little bit. If we're talking about financing as a value multiplier, so we've been talking about how this helps scale a business, using capital to build infrastructure that helps make the business more attractive to buyers, those kind of things. So, how can this, maybe JT, this is to you first, like, how do you start guiding? I know that you probably refer to Seth, but how do you start guiding people down the, all right, I want to buy this business or I want to sell, but I don't even know where to start on the financing and money side. Like Tim, you probably just went through some of this more personally, so we should talk to you about this too in a second. But JT, I'll toss it to you first.
Yeah, Tim will, with Tim's answer, that'll be direct from the horse's mouth. But
Yeah.
from my seat, there's really two forms that I work with SBA on. And one is people calling me to buy a business.
Mm-hmm.
And the other is expansion from existing business owners. And it makes sense. SBA, in fact, I don't think I've ever successfully done a conventional loan in 25 years for a small business loan. They're just not applicable. SBA is so wonderful and it's their strike zone. When it comes to a transaction, if there's greenfielding a location, if there's an expansion, I always view growth as the stair step model. You're going to invest and you're going to get some assets and then you're going to plateau a little bit and wait for some of the sales and procedures and all things growth related to catch up to that investment. And what's riskier from my seat, and Tim, you probably see this all the time, is when companies decide to grow and then invest and try to catch up to that growth. And that's where paperwork can be a challenge and, lawsuits occur and your business just isn't as buttoned up as it needs to be to catch up. So I would much prefer to see that investment ahead of time and get dialed in a solid foundation and then go for the growth. And SBA is a perfect resource for that, depending on what kinds of growth, whether it's an investment into, let's say, a contents facility or it's greenfielding a location or any number of ways to grow a business. But I'd much rather see the growth first or the investment first, sorry, and then the growth to follow.
Yeah, I would agree with that, JT, but I think it also needs to be coupled with some sort of strategy.
Mm-hmm.
When it comes to making a decision to borrow money to finance the growth of your organization, a lot of times it comes down to risk. I mean, personally, I put up one of the two golden retrievers and my youngest child as collateral. The golden retriever is not worth anything, but my son's probably worth making sure that it works. But at the end of the day, the decision to borrow money as a vehicle to help grow your business really needs to have a strategy that goes along with it. If you're looking at, like you said, JT, expansion into different locations, maybe an increase in capital investment to meet an increase in demand. Maybe it's a new client base, a new service line that you're into. There's a window of opportunity with all of those things. And if you wait on the sidelines to acquire the capital yourself to make that growth investment, a lot of times that window of opportunity is going to pass you by. Somebody else is going to step into that place. Somebody else is going to expand to that location. Somebody else is going to expand their resources, their supply to meet the demand. We work in catastrophe zones all the time, and there's abundant opportunity there, but it has to be done right with the right people, the right plan, the right equipment, and all that requires money. So it's the lubricant, man, that makes your business go. And it all depends on how much risk you want to take.
Yep. Perfect. Okay. Any final questions? I want to go into the lightning round and maybe each of us can rapid fire a question at Seth. I have one in mind, but JT, do you have a question you want to ask Seth as we kind of wrap it up?
Oh, I think my question would be a little more complex, but what are the one or two biggest changes, Seth, in the last 12 to 18 months that would benefit a borrower? That it used to be a certain way with SBA the last 25, 30 years, and now it's changed? Because I know there's a litany of them, but what are the top two or three?
Yeah, so a couple come to mind that we were really never able to do before. One, and this helps especially with larger transactions, is the ability to do a partial change of ownership. That was always ineligible for SBA historically, and that is something, and I've been able to take advantage of that within the restoration space quite a bit here in the last 12 months or so. And to give you a sense of what that is, normally what the SBA wanted to see, or historically was always wanted to see, was a 100% change of ownership, right? So John Doe goes in and buys, 100% of the assets of the business, and it's a 100% change of ownership. So what this the new SOP allows for is, let's say, whether it's an existing GM that maybe doesn't have the financial wherewithal for a down payment, it allows them to maybe buy in at 20%, 80%, whatever the number may be, to allow for, it could be a couple of things. One, to maybe keep it within sort of an SBA parameter in terms of size, but also it allows for leveraging equity on the balance sheet in lieu of a cash injection, just meaning, generally speaking, with a 100% sale, the buyer has to come up with at least 10% of project cost, at least in most cases. This would allow for the ability to maybe limit that a little bit and rely on the strength of the balance sheet of the business as opposed to that cash injection.
Thank you.
So hopefully I explained that adequately.
Yeah, thank you.
If the situation comes up, certainly can go more in the weeds there. And then the other one would be refinancing existing SBA debt. That was something where it could theoretically be done, but generally speaking, you'd have to send it to the SBA for approval, and it was a pretty difficult process. Now, as long as it makes sense, you can show a certain level of benefit by doing so. That is actually eligible now. And so we've been able to take advantage of that as well. But I have heard there's some new changes coming out that may limit that one. So stay tuned on that.
Okay, thanks.
Where should people stay tuned on SBA, like when there are changes? I mean, I feel like it's probably like Google and social media in my world where there's always changes going on. Is there just a good resource for people to look toward for changes?
Well, I mean, certainly the SBA website, Live Oak website. I'm on LinkedIn. I try to have periodic updates on changes, and so other industry folks sometimes will post updates as well. But I think that, SBA is always a good source, and I'm happy to, even if it's just a generic conversation, it doesn't have to be a request. I'm happy to help answer questions or provide updates as well.
Awesome.
Seth, you guys also have a nice newsletter. I think you put out monthly or quarterly that's got some really good insights into it. How would people be able to find that?
Yeah, I mean, if you don't follow me on LinkedIn, I mean, reach out direct or again on our website. We have a pretty good website that has a lot of information, but I'm happy to provide that directly as well, whether it be through LinkedIn or email. I'm happy to do that.
Perfect. Liveoak.bank is the website for people who are listening if you want to check that out and learn more about what they do and the different options there. Tim, do you have a question for Seth before we wrap it up?
Absolutely. So the most common one we're hearing these days, Seth, is, interest rates are just crazy high. I don't want to borrow money at these current rates. What do you say to people like that?
Yeah, I mean, there's really nothing you can say to make people feel better, I don't think, other than just it's the reality. I will say that when rates started skyrocketing 18 months ago or whenever that was, it got pretty quiet. I think it took a little time for people to kind of accept the new reality. I think especially for younger business owners that have never seen higher rates before, I think it's especially challenging. Just kind of, but historically, this is kind of more norm, right? I mean, we're just used to the last 15 years or whatever having historically low rates. And so now it's kind of a reset in understanding that this is sort of the reality. So that may not make them feel any better, but at the end of the day, it is what it is. The 3% prime will probably never come back. So this is what we got to live with going forward.
Yeah.
Can I ask another one, Michelle?
Sure.
Yeah, absolutely.
All right. So, in when you talk about planned successions, we went through a planned succession ourselves. And fortunately, I had a lot of time to prepare for it. But there's other, great employees, management that's out there looking to maybe take over the business that they're working with or for into a second generation, a third generation, if you will. What do you say to those folks, Seth, to help them prepare for that day where they are going to have to go and borrow money for that acquisition?
Yeah, I think just going through I always encourage people to reach out sooner than later, even if their request is not necessarily going to be in the short term. It's helpful to have the conversation going back, what's needed. Again, maybe talking back to the business plan projections, what kind of financial information we need, what we're looking for from a qualification standpoint, whether it's cash reserves, whether it's experience, how they fit into the business and does it make sense? Are there any, risks that we're mitigating? But the sooner we step in and kind of address that, I think that's key, because it may give them time to rectify any issues, or at least plan accordingly and make sure they're prepared when they get there.
Good stuff.
Okay, I'm going to ask all three of you this last question, actually, because I was thinking about it. What is the one thing that you wish business owners understood about maybe getting an SBA loan or getting some sort of backing like that to help you grow your business? One thing that you wish business owners understood about leveraging debt for growth. So Seth, I'll toss that to you first.
There's so much variability with that. I get a lot of different concerns. I think maybe the one that stands out, just because it's so black and white, is just, yes, you do have to provide a personal guarantee. That's pretty much standard with any loan. But it is an SBA requirement that anyone with 20% or more ownership will have to guarantee the loan request. So that's a very black and white one that stands out.
Okay. JT, anything that you wish people understood?
Yeah, I think the listeners have heard this panel talk about an exit-ready business or an exit ramp or getting their financials cleaned up. The same thing is with being lender-friendly. You can't start this process with a bunch of messy books, and it just doesn't make sense. And when Seth takes a look at books like that, there's a certain level of digging that has to happen to uncover the story, and the simpler that story, the better. So do a little bit of work in advance. Talk to me, talk to Tim, talk to Seth, whatever it is, but go with a good story. Let's let Seth's job be easier than harder, and your chance of success is going to increase.
Yeah. Tim, how about you?
Mine's going to be with how you keep the books. So kind of closely related to what JT's talking about. When you make money, paying taxes isn't necessarily a bad thing. And some go to the extreme, maybe or maybe not at the advice of their CPA, to mitigate their tax liability. But when it comes time to borrow money, that can be a difficult conversation. You have to support why you need that money. And you can't minimize your taxes and borrow money, by manipulating the numbers one way or another. You got to show a clean sheet. So you might be saving yourself in one area, but handicapping yourself in another.
Yeah, well said.
Yeah. Okay, well, gentlemen, thank you so much. Anything else that any of you want to add before we wrap it up?
That's it. So, thanks to Seth. I know conversations that we had early on about the VMA transition plan were very beneficial to me. So I would encourage anybody just to reach out, even if you've got general guidance. You don't have to need a loan rate today, but I know Seth is a great resource that you can tap into.
Yeah, agreed.
Yeah,
All
I'm
right.
available anytime. Thanks for having me.
Yeah, Seth, JT, Tim, thank you so much. To those who are listening, you can find more episodes of Chasing the Vision on the CNR website and on our YouTube. So far this season, we're in season 2. So there's a whole season last year. So far this year, we've talked about Tim's acquisition of VMA and what that looked like. We had a guest in that episode as well. And we've talked about financial cleanliness, and we've also talked about having a better 2025 after 2024 was a pretty big struggle for a lot of restoration companies. So there are more episodes to come. Stay tuned. Again, you can find Seth. You can see his email is at the bottom of his image on the screen. You can also go to liveoak.bank. You can reach out to Tim and JT or myself, and we can connect you as well. And we look forward to seeing all of you on the next episode. Thank you so much.
Thanks, Michelle.
Thanks, everybody.
Thanks, everybody.